Curious about how portfolio management services really work? Want to understand how your portfolios are built? What kind of strategies are right for your financial goals? Or is a PMS right fit for you? We are hosting an exclusive webinar, I Thought PMS Universe, everything you need to know. This is your chance to get a complete walkthrough on our PMS philosophy, our strategies from blue chip to multi-cap to small cap, and how we manage risk and performance over a long period of time. Whether you're exploring PMS for the first time or want to get deeper into how we work, this session is designed for you. It's online, free, and open for all. Tap the link attached below to register and get the invite.
Let's start off. Yeah. So just let's take a post-COVID recap first. What happened post-COVID, right? So if we see what led to the growth post-COVID, right? So there was a post-COVID structural demand shift. There was a heightened awareness and increased focus on health, right, which boosted demand structurally. That was one of the reasons. The other thing that we saw in the stocks or stock prices performance, right? Hospital stocks over the past 5 years have outperformed the broader pharma indices. If you look at a 5-year picture or even a 3-year picture, I think hospital stocks have significantly outperformed the broader pharma indices. The occupancy rates, right, they are almost near the peaks. At least occupancy rates of the older expansion that the hospitals have done, they are almost close to 65 to 75% for older expansions, which has led to operating leverage for most of the hospital players, and which has led to improved profitability. And also the investment momentum, right? So if we see post-COVID, the PVC money and M&A money has been significant, and investors are ramping up bets with billions of dollars in capital inflows, right? The M&A activity is very buzzing in the hospital space even right now. Yeah. So this is just a chart of various hospital stocks versus the broader pharma CNX Pharma Index. So if you look at the last 5 years, we can see so all the hospitals, Max, NH, Fortis, Aster, Apollo, KIMS, all these major listed players have significantly outperformed CNX Pharma. CNX Pharma, which has given approximately 115% over the last 5 years, and if you look at the top performing hospital stock, is almost 1,000%, right? So 10 times. If you look at NH, that's all 679%, almost six and a half times. Fortis, Aster, both 500%, Apollo 400%. So significant outperformance versus the pharma index, right, over the last 5 years. And if you look at the occupancy rate, so as I said, right, if you look at the occupancy rate of various hospitals, the chart on the right, shows the occupancy rate of Apollo, Max, Narayana, Fortis, Aster. So if you just look at the chart, right, just observing it, you can see that 16 to 18 was a period where occupancies were stable to rising, and then post 18-19 was a period where occupancies, started to fall. COVID and post-COVID years were the rock bottom for occupancies, and then again post-COVID we see occupancies have picked up sharply. So that's exactly what has happened to the occupancies. So 17-18. What happened that most of the hospitals or many hospital chains added beds, could be either greenfield or brownfield, or could be a few acquisitions. So all these acquisitions are basically where the occupancies or newer beds where the occupancies will be slightly on the lower end, and so the console occupancy falls. And then COVID, obviously the procedures were delayed, so it hit rock bottom, and then there was a swift recovery post-COVID. This is because of two reasons. One was pent-up demand, and then the other reason was that there was a consolidation phase wherein most of the hospitals did not do a lot of Capex or added a lot of beds because they improved the occupancy and the operating leverage played out. Yeah. Then coming to improvement in ARPOB. So if you, this is a table which is showcasing, the ARPOB growth rates of various hospital chains over the last 5 years. And if you look, a few reasons why ARPOB has improved is basically because most of these hospitals are focused on more complex surgeries, more profitable patient mix, reducing the scheme mix, getting more insurance, more cash patients, and more profitable therapies. So many of these hospitals have also increased share of onco, which is sort of a more profitable therapy for them. So all this has also led to an improvement in the ARPOB. So if we look at Max, right, Max is one of the highest RPOP generators among the hospital chains at 77,000. And Kim's has been one of the fastest growing at 15.8% CAGR, 15.8% CAGR, right? So we can see that the improvement in RPOP has been due to various measures taken by these hospital chains. And again, I spoke about M&A being on the rise, right? So if we look at the scale of investment that was happening pre-COVID and post-COVID, it's a significant change, right? If you look at the total PVC investments, they've increased from 361 million to almost 14.5 billion. So 361 million was a era pre-COVID between 15 to 19, and post-COVID, which is 2025, it has gone up almost 4,000%, right? One more metric or one more data point is the average deal size, right? That has gone up from 17 million to 200 million. So that's again a 1,200% increase in peak annual investment. Maybe pre-COVID it was 94 million in 2011, and then post-COVID 2023 there was a peak annual investment here of 5.6 billion. So again a 5,800% increase pre-COVID versus post-COVID. So these figures just show you the quantum jump that's this industry has seen post-COVID. And just 2 years, which is 20 to 24, between these 2 years, hospitals alone undertook an M&A worth 6.74 billion, and out of which approximately 5 billion was from private equity investors. So these are a few major, M&As that have happened over the last few years. And if we look at the EV/EBITDA ranges, EV/EBITDA multiple ranges for most of these M&As, so they are ranging anywhere between 18 to 35 times, with a median multiple of 24 times. And the single specialty providers, someone like an Indira IVF, that deal commanded a premium that was at the 35 times EV/EBITDA. So some hospital with some specialty, they have commanded a premium in terms of multiples, in terms of transactions. And again, PVC investments have dominated the larger transactions. Almost 7 out of the top 10 are from PVC guys. So just look at a few of them. I think top 2, 3, which is Manipal and Temasek, 20,000 crore value, right? 10,500 beds acquired. Aster and Fajar Capital Consortium, 10,000 crores. Care and Kims, right? With Blackstone QCIL, that was a 8,400 crore deal. Indira IVF that I spoke of, that was again a 5,500 crore deal. So big deals that way from private equity investors. And also on the listed players front, right? It's not only P or VC money. Even the listed players have, done a lot of M&A. If you look at Max, they've been very active. So Max has acquired JP, which is one of the bigger ones. They also acquired Sahar, which was one of the bigger ones. So these 2 deals, Max were the bigger ones. Coming to Apollo also has done a few acquisitions. Even Narayana on that front, they did a few acquisitions. Mainly, there's one big decent acquisition on the ortho front, Shiva. So added a few specialty that way. So the major point being that the M&A has been from the PEVC as well as the listed players. Yeah. This is now the current landscape and expansion plans, right? So if we this table, what table suggests is what are the current beds of major hospital players in 25, what are the target number of beds as per their expansion plans? What is the percentage addition, right, between 25 and 28, 29? How much percentage of the current capacity or current beds are they adding? Again, what is the Capex that is envisaged for that? I've also tried to put out a split of greenfield and brownfield beds, because I'll explain, going ahead in the presentation, what difference does it make for a greenfield and a brownfield bed. And finally, the expansion model, if it's a owned model, lease model, or an O&M model, that will also have an impact on the financials, on the payback periods and the return ratios. So there's just a table of that. And if we look at the table closely, 2 guys, which is Max and Apollo, these 2 guys are adding almost, the maximum amount of beds in the next 3 to 4 years as a percentage of the current bed addition. So Apollo is almost adding 54% of the current bed capacity. Max is adding 74% of the current bed capacity in the next 3 to 4 years. And if you look at KIMS, they are also close to 50%. Even Aster is close to 48%. Right, Narayana and Fortis are slightly lower than that. But coming to the brownfield expansion, I think again, Apollo, they have the maximum amount of brownfield expansion. Brownfield is basically adding beds in the similar facility that you have. You have space in that facility, and you just add a new block or a new bed. So that's more beneficial from a payback period perspective. The occupancies will be faster, right? And there won't be that of a ROCE hit because the Capex will be lower. So yeah, that's what this table suggests. Yeah, so this is the slide that I was talking about. So basically, this is the total number of bed additions that these guys have planned. And if we look at the asset light percentage of the total addition, so asset light percentage is basically, it could be a leased or a O&M or these models, basically leased O&M models. So if we look at the asset light percentage addition, I think Max is doing the maximum number of asset light. So in Dwarka, Mohali, Thane, all these almost 1,200 beds is on the asset light basis, where where they won't have significant capex, and that's why maybe the return ratios could be better. So Max has the highest percentage of asset light addition, followed by KIMS. And if you look at Narayana, they are primarily doing via owned, which is a capex heavy model, and similarly for Fortis. And even Aster, I think only 3 to 5% of the beds are on the O&M project. Otherwise, they are also doing own. Yeah. So there's just a slide explaining the previous two tables. So almost all top hospitals, have bed addition plans over the next 3 years, ranging from 36% of current bed capacity to 74% of the current bed capacity. Max, as I said, is adding the highest amount of beds, 3,700 beds versus their existing beds. But almost 32% of their addition is asset light, which will require a lower capital. On the other hand, Apollo and Narayana are expanding primarily via owned beds, but which will be more capital intensive, obviously, and will have longer payback periods. However, Narayana's major expansion is in their core markets, which is Bangalore and Kolkata, where they already have flagship hospitals. And because they already much faster. They already have that brand value in those markets, so the occupancies could be much faster versus a normal greenfield expansion, newer area. And also the expansion is more back-ended, so anywhere in 28, 29 is where the majority of the beds are coming in. Fortis is also expanding by owned beds, but it is primarily brownfield, as I said. So again, there the yield could be better and the ROCs could be better, and the payback periods could be lower because it's majorly brownfield. Yeah. So let's see. Will it dilute margins and ROCs? So most of these hospital chains have the expansion plan, right? Will it dilute the margins and ROCs? Yeah, so this is a very interesting table, in my opinion. So this is, I've referred back to the last investment cycle of major hospital players, right? This table is basically CFI, is cash flow from investment divided by fixed assets. So in CFI, or basically the investment, I've taken the capex plus the acquisition, or if any acquisition they will have done, or any investment in the subsidiary hospital that they would have made. So all the investments, basically capex heavy investments that they would have made, that divided by the fixed assets. This is that ratio table. So what I'm trying to show here is basically, so if we see the last investment phase for most of these hospitals was broadly between 2014 to 2018. That is where the ratio of Apollo, NH, Fortis, Aster, all these guys was in double digits. So Apollo was anywhere between 23, 25%, 15%. Right, NH was again 23, 20% in 14, 15. It was 20% in 18 again. Even Fortis was 14% in 14, 16% in 2016, 25% in 2017. This is investment as a percentage of fixed assets, basically. In 2019, it was 43%. Even Aster was in the similar lines. And if you look at the 3 years after 2019, which is 20, 21, and 22, this ratio has fallen to single digits. What this suggests is basically that the investments slowed down and there was a consolidation phase. The hospitals consolidated their beds, and they used more of their existing bed capacity, generated their operating leverage, picked up the margins, picked up the ROCEs, and then again, if we see towards 24-25, this number has started moving to double digits, suggesting that they are again going towards a capex cycle. So I think, yeah, this is a very interesting table that way, just to understand the previous cycle of investments of major listed players. Yeah, and this is just a chart depicting that same. So I think it's better observed on the chart rather than the table. So just looking at the chart, we'll see that from 14 to 20, this ratio or this numbers have been coming down, hitting rock bottom in 2021, and then again going up. And this is broadly for all the hospitals. I think Fortis is just one outlier where in 2019 they're having a big spike. But apart from that, the general trend is that 14, 15 onwards, or 18, 19 onwards, this number is dying down, and then it's again moving up as the hospitals are putting in money. Yeah. So just to see, we'll take one example of one listed player. What happened to them in their previous, expansion cycle? Did it dilute margins? Did it dilute return ratios? What happened to the stock price in the previous investment cycle? So the case is NH, Narayana Vidyalaya. What happened was that Narayana was in an expansion phase from almost 15 to 2018. They expanded and acquired a few facilities as well. Gurugram was one, Mumbai was one hospital, Delhi was one hospital, and they also bought out. They have an international business, international hospital in Cayman Islands as well. So they before 2018 it was an associate, and then they bought out the stake in Cayman. So that was another investment that they made. So if we see the fixed assets, right, fixed assets double from 900 crores to 1848 crores, from 15 to 18. So I've highlighted it in yellow, the fixed assets from 913 crores to 1848 crores in 3 years. And just on the borrowings also, that went from 362 crores to 800 crores. I mean, stating that there was a debt funded capex done. Yeah. Coming to margins. So what happened to margins? Margins which were already, suffering from lower occupancy hospitals or newer hospitals, which were the assets were not utilized fully. They again took a hit. So there was some recovery to 13% in 2017. In 2019, they fell back to 10%, right? Because the new hospitals with lower occupancies hit, their P&L. So margins declined from 13 to 10. And if you see post 2020, operating leverage started to playing out, and so if you see 23, 24, 25, those 3 years, the margins are upwards of 20%. So operating leverage played out in post-COVID years. And again, return ratios went back to single digits as assets were not being optimally utilized. So from a 14% ROCE, they went to 9% single digit ROCE. And then again, as post-COVID operating leverage played out, and the hospitals matured, the return ratios increased significantly. Yeah, and what happened to the stock price, right? I think there is an IPO somewhere in 2016, 15, 16, and nothing. For 4 years, 3 to 4 years, no returns. The stock was flat. It then moved up again back in COVID. So it was, just there around for 4 to 5 years, no movement. And as soon as, operating leverage started playing out, numbers starting hitting the P&L, hospitals started to mature. Significant, growth in the stock price as well. It went up from, I think, 200 odd level to 2000, so 10x in the last 5 years. Is this time around something different? Is this capex cycle something different? So again, right, most of the players that are expanding have older, mature hospitals this time, which will sort of keep contributing to the profitability. I think in the last capex cycle, many of the hospitals had many newer hospitals in the mix as well. That's why we see in NHS case also that the margins were not significantly higher. They were, somewhere close to that 13% range, signaling that still there was not, the assets were not optimally utilized at 13%. But still, with the capex, they went down further 3%. So this time around, I think a lot of older and mature hospitals are there, which will keep contributing to profitability. There's a mix of brownfield and asset-light expansions as well for a few of the hospitals, right? and that will have a lower hit on the ROCs versus the previous cycle maybe, and the margins. So a hospital chains with a mix of these expansions will probably be more balanced out than significantly heavy on the greenfield expansion. And many of the expansions are coming in the regions where these players are already operating and they have a brand presence. And that's why I think the occupancy this time around could be slightly faster. However, taking all this into consideration, putting up assets, hospitals is a business where have to put up money upfront, and then the payback is over 7-8 years maturity. So, saying all that, the expansions will come with impact on financials as the hospitals come live. And this is just a nice table that Perplexity had put out. Perplexity had put out. So this is just comparing a table comparing key listed hospitals. I think I need you to look at the EBITDA margins, right? Many of these players have already started putting up investments. Few hospitals started to come live. If you look at the aggregate EBITDA margins, right, they are already flat year on year. A few of the hospitals, have had margin improvement. A few of them have had margin decline because of their own respective reasons. But on an aggregate level, the margins have been flat year on year in FY25. This is the EBITDA margin. And coming to valuation, so valuations have become rich, right? If you look at across the board, I've compared the EV EBITDA multiples. Fortis median multiples are close to 23 times. Currently, they are trading near 35 times. Even NH, the median multiple is close to 20 to 23 times. It's trading above 30 times. Even Max, for that matter of fact, is trading at very rich valuations, close to 65 times. Similarly, for Fortis, this much above median multiple levels, trading above 35 times. So the valuations across the board have become rich, factoring in some growth from these expansions. Yeah, similarly, I think for Aster and KIMS. So what should investors look out for? I think a few key things. Execution is very important in this space. So I think execution on capacity, whether there are no delays, on the additions, land acquisitions, etc., etc. So execution on capacity plus on your capacity addition, maintaining the margins. Asset heavy versus asset light. So we discussed right that the asset light ones will have a slightly lower impact on the ROC. So monitoring the shift from asset heavy to asset light for better returns. Operating leverage signals, again, the operating leverage that played out for most of them in the last 5 years was from improving operating metrics, obviously, improving occupancy, improving RPOP, specialty mix. So these are operating metrics are something that an investor should keep on tracking. And also again, assess if the Capex is translating into sustainable returns, basically keep tracking their growth and investment in the newer hospitals. Yeah, so these are the sources that I've used for my presentation. Yeah, coming to Trueblu, which is our large cap fund, right? I'll talk a little bit about that now. So what's the ithought way, and what's our investment philosophy? Basically, it's a long-term focus, non-consensus investing, the bottom-up approach, and there's a high focus on risk management. What we're trying to capture in Trueblu is basically the India growth story plus the global champions out of the India export story. So we're trying to capture both these stories in our Trueblu portfolio. What's the USP? It's a 100% pure large cap portfolio with a high active share. It's a very low churn. It's a buy and hold strategy. There is zero fixed fees. So what do we look at, right? We look at strong fundamentals plus attractive valuations. Corporate governance is of prime importance. Strong leadership teams with a track record of execution. We try to go with industry leaders with high return ratios and mostly zero or low leverage. And finally, reasonable valuation. We would not like to overpay for it. These are the four pillars. As I said, it's large cap portfolio. So you just see 25 stocks, 25 large cap stocks and one mid cap. Yeah. So this is just a BSC 500 versus Trueblu PAT comparison. So for Trueblu, 5% stocks contribute to 33% of the profit, right? And that's it's completely opposite for the BSC 500. Yeah, there's Trueblu Champ 1. So if you look at HDFC Bank, book value has compounded. 12-year CAGR is 20%. Share price 12-year CAGR is 15%. And it's a execution machine, right? So the bank managed to match its entire earnings of FY18 in just one quarter of 2025, which is Q2 of 2025. So it's a compounding machine, and this is not for the first time they have done it. It's it's a regular affair. Yeah, this is another example of a true champ. So ITC, I think we started buying somewhere in June, July 21. The financial performance was good. It was going up, but the stock price remained flat. We held through. We bought more. I think we held through with conviction. Finally, the performance was still up, and the stock price moved significantly. And we are still holding it. So as I said, it's a buy and hold strategy. We'll be with the stock as soon as as long as it is delivering on performance. Now there's a few metrics on ITC: 6-month sales, rolling 6-month PAT, free cash flow, and ROE. Yeah, this is a chart depicting the drawdown of Trueblu versus the other large cap funds, right? And just like to highlight that there are a few instances where Trueblu has significantly outperformed over the Nifty. So by outperform, I mean that the drawdown has been much lower and the volatility for an investor has been much lower. So if you look at this is a June 22 event where Nifty was down 17% from the peak. And Trueblu was just down 12% from the peak. And you can see the performance of the other comparable funds. So an investor with Trueblu has to deal with significantly lower volatility versus even the benchmark. Similarly, I think one more event in 23 where Nifty was down by 10 and Trueblu was down by half of that, which is 5%. Yeah. What's our endeavor? Basically, what we try to deliver is benchmark, and what the expectation should be is benchmark plus 200 to 300 basis points return. And the time frame an investor should work with is basically a 3-year rolling return, 3-year time frame. Yeah. Predictability. Yeah, this is the investment team. I think Mr. Shyam Sekhar, editor and founder, and Mr. G.R. Balaji, he's the head of research and co-fund manager of Trueblu. And apart from these two, we also have a very wide investment team. This is the performance. I think over 1 year, over 3 years has been outperformance. Yeah, and the other key terms, I think 50 lakhs minimum investment, fee options. There are 2 options: 0 fixed fee plus performance fees of 20%. Performance fees of 20% profit share above a 6% hurdle rate, and the other option is 1% fixed fee. In close, I thank you guys again for joining in, and I hope you found this presentation insightful. Thank you, sir.